Hi all, welcome back to Money Manager's A User's Guide. I'm Nathan Peters. Due to inclement weather in Sydney this week, you lot get to look at some screenshots, but don't worry, I'll try to make it interesting. So one of this channel's top 4 videos since launch in September 2020 with over 1,000 views is the Norway Oil Fund Review. Most of its traffic originates from Google search, and considering the importance of that fund to the populace of Norway, I can understand the interest. Since we moved to Australia a few months ago, I've been learning about another resource-rich country with a large pension sector. But instead of one fund like the Norwegians, Australia has gone the admirable route of crafting a regulatory framework by which private entities manage and compete for Australians' direct contribution savings, called superannuations. The ones we'll discuss are organized to be 4-member organizations like Vanguard, so any cost savings accrue to members, not shareholders. Since November last year, anyone can choose any fund, and the Australian Tax Authority carries out annual long-term performance reviews and names and shames the laggards, driving natural consolidation in the industry. Not surprisingly, the best performing funds tend to be the largest, since they can keep implementation costs down in equity risk-dominated portfolios. Although it has been difficult to source reliable daily return data for the 78 super products listed online, I did manage to find 2 of the largest, best-performing funds' daily returns since 2017, and those are Host Plus Superannuation Fund and Australian Super. In order to outline the contours of their portfolios in our statistical software Venn, I've just equal-weighted these funds in a dummy portfolio and run it through Venn's multi-factor lasso regression lens. To be honest, I was surprised by these funds' productivity levels. The largest super, Australian Super, at 233 billion Aussie dollars under management and growing to $500 billion by 2026, manages everything from direct property to infrastructure to private equity to listed equity to credit, with 1,000 employees farming out about $50 billion of the total to 12 external international equity managers, and the same again to credit and fixed income managers. Although they may want to reference this channel's assessment of Baillie Gifford, which they have $8.5 billion of exposure to, link in the description below. With about 50% of the fund's allocation listed to equities, you would think that it would have at least half the volatility of the equity market. But as we can see here, the supers achieve about 35% of the MSCI World Equities Index volatility, with 77% of the return over the period we have, creating a far superior Sharpe of 1.2. Now, to be fair, we don't have the daily returns for these funds during a really difficult bear market, like the one in 2008. But Venn's hypothetical vulnerability scan reckons the supers would be down 10 to 20% in a 2008 scenario, a period when the index dropped minus 60%. Those are some world-class downside protection statistics, if accurate. As we saw with our review of trend following strategies, link in the description below, if you can truncate the downside, the upside takes care of itself over time with a positive expected return. Now, if we look at discrete scenario analysis, it looks like the highest downside participation would come from a 3 sigma or worse event in credit, as expressed in the Global High Yield Index. But even that is just about half the losses from credit. So bottom line, what do you get from the best supers in Australia? Muted equity risk in exchange for some emerging markets risk, credit risk, short volatility risk, and a bunch of residual risk here that is undefined but stems from the unlisted investments we mentioned above. The returns from that activity have been impressive. At over 4%, about the same level as we discussed with RIT Capital Partners last week. Importantly, however, with Rothschild, we knew that the alpha evaporated and went negative in the 2008 downturn. But Venn just assumes that a positive sign on Super's alpha stays positive until proven otherwise by actual data. This is dangerous with illiquid assets in my prior experience and opinion, and perhaps the downside participation in the next downturn, one that looks like 2008 rather than a single COVID shock month in 2020, won't be as amenable to their members. Given the Australian super fund is currently sitting on 36 billion Aussie dollars in cash, earning a negative 7% real yield, despite an inflation mandate, perhaps the supers could afford a little bit more in the way of skill-based liquid alternatives. That way you can reduce the cash drag that reduces purchasing power from inflation while maintaining price daily liquidity for entering and exiting members. My initial portfolio modeling shows you can improve the already good Sharpe ratio and give yourself a fighting chance not to have to sell liquid assets at the bottom to support the illiquid investments that need cash in a downturn. Just throwing some ideas out there. Well, that's it for me on Money Managers, a User's Guide. If you found this video useful, please like, comment, share, subscribe, and hit the bell for future notifications. And remember, use your money managers. Don't let them use you. Thanks.